I got to break it to you folks. Trading is not easy. And those who say it's so easy, it seems easy when you're making money. When things are going against, though, it's not so easy. And as a position trader, I want to give you some ideas about what to think about and some concepts to kind of think over as you manage a position over a period of time. And we can, of course, go to our example position that we have here to talk about this, okay? So UVXY, our position now is, to refresh your memory, is that we are long a put spread, which means that we make money if UVXY goes down. Now, UVXY being a volatility, a VIX ETP, UVXY goes up when the VIX futures go up. So, and generally VIX futures go up when people are scared about something happening or when the market goes down. So today we came in overnight. If you looked in the middle of the night, the futures were up slightly, but early morning, that turned around and we moved lower. So here you can see from, if we look, this is like 3 in the morning. We were up slightly. Let's go back. So if we remember, we reopened yesterday, Sunday night. The weekend was off, right? This is Friday. The chart here skips from Friday evening at 4:30 or 5 o'clock, I guess, to 6 p.m. Sunday. And we see 6 p.m. Sunday, it's kind of like nothing's going on. Then we notice the market is slightly up, and we kind of move around back and forth, but in a pretty small range. Then at like 1 in the morning, we're up about 5 points. And then things start to go not so great after that. 2 in the morning, 3 in the morning, up. And then 4 in the morning, we get this down move. Continues down past 5 in the morning. And that moves us into the open. Continued down move. Not a huge down move, but definitely a significant down move. Finally, we get to 9:30 in the morning, and here's the open. And we're down. And the market's being down. This is the E-minis. The market's being down means that the VIX pops. And indeed, when we're looking overnight, we can't actually see the VIX because it's not registering, but we can see these VIX futures. And we saw these VIX futures overnight at like 1 in the morning. We saw them down, 10 cents, 5 cents. But then as the market turned lower, we saw them moving higher, these VIX futures. And we know that UVXY is based on these first two VIX futures, the Q19 and the U19 future. And so if those futures are up, that means UVXY is going to be up. And indeed, we open with UVXY up. It's currently up about $1.50. Now, if we look to the analysis tool, if I click on UVXY, and I've got these screens linked, so when I click on UVXY over on the left here, the screen on the right is going to pull up the chart. When I click on UVXY, you can see the action so far today. All right, it ended around 32.50 on Friday. We opened up just about a point to up around 33.40, 33.50, and we've stayed above that level pretty much ever since. The lowest we got during the trading session was 33.20. And to review where this price action in UVXY is coming from, it's not coming from people buying and selling UVXY. Price action in UVXY is coming from essentially the market makers making a market around the index that shows volatility out 30 days. But to look at the relationship between the futures, just to give us some sort of guide stick as to where we stand in the relationship between the futures that UVXY is based on, we can go to VIX Central here. And we can see from this chart here that we are in a sort of elevated stance. You can see that the spot price of the VIX is above all futures, and the relationship between the first month and the second month future is a relationship of backwardation, that meaning that the front future is higher than the second month future. Now, when we have this situation, all things not changing, these futures are being pulled up towards the spot price. So none of this is good news for our short UVXY position. If we reflect back here, we go to the Analyze tab, we can take a look at our Greeks for this position. That's a common way people look at their position, and it shows us short 297 deltas. That means essentially each dollar this goes up, we lose $300. So with this up a little over $1.50, we're going to lose, we lost $300. That would be up $1, plus up 50 cents would be about 150 deltas. So somewhere, we should be losing somewhere around $500 if we look at our deltas and how far we've moved up. And indeed, if we look over, it shows us being down $468 at the moment on the day. Now, so that just kind of is an example of how these deltas do work to show how much you'll make or lose. Let me go over that once again. UVXY is up $1.57 on the day. If we look at our Greeks, we see that our delta is just about short 300 deltas. That 300 deltas short, one of the definitions for delta is the dollars gained or lost for a 1 point move in the underlying. So for a $1 move in UVXY, we will lose $297 or about $300. For a 1.5 point move in the underlying, we will lose $300 plus half of $300, so $450. And indeed, we've got a little bit over a 1.5 point move, and we've lost $480. So this is an example of a position that is going against us. I will get to your question, man accounts. Stick with me here, and I will get to it. So we're in a position that's going against us. So let's look at a couple things here. First, very important thing about a position is what is the time frame that we're dealing with here. If this position it only has today for it to work for us, then we're in big trouble. Let's first go through the position really quickly and then look at the time frame. So the position is we are long this September 30, 27 put spread. That means that we will make a maximum profitability if UVXY is at or below 27.50 on expiration 25 days from now. So our time frame is basically 25 days, so a little over 3 weeks, which is good news because that means we've got some time to play with here. But this time can go by pretty quickly. But we do have time to play with here. Okay, we own 30 of these spreads. So if this was a dollar spread and we own 30 of them, then that would be easier to do the math on. 30 times a dollar is $3,000. So if it was 30 times a dollar is $3,000. If it was a $2 spread, then it would be $6,000. Since it's $2.50 spread, it's a little bit more than that. In addition to this spread here, I did make one trade today, and this goes back to patience, but I did make one trade today, and what I did, I'll show you right here, is I rolled two of my spreads from the September 30, 27.5 spread to a couple weeks farther out in September 30, 27 spread. So we rolled a couple of our spreads out a couple weeks and made them a little bit wider. And we had to put a couple bucks into the whole transaction to do that. So we ended up paying 37 cents to roll two of these spreads out a couple weeks, giving us just a little bit more time for things to work out for us. And basically, the point I want to make today is that some of the best things you can do is to do nothing at times. Any trade you make as a retail trader is going to cost you edge and money. Edge because you're probably going to have to give up a teeny bit of edge to put a trade on. And also you're going to have to pay commissions to put a trade on. So in many, many cases, the correct response is to do nothing. The other point I want to make to you here is that there is no correct, when we're looking at this in real time, there is no correct move in many situations. Now, you could look at this a week from now and knowing what had happened and having the benefit of seeing into the future, you could say, well, that was probably, that it would have been a better move to do this or that. But when you're in real time and you need to make a decision, things can be harder. And what I would suggest to you is to develop a reasoned, calm, mechanical approach. And by mechanical, I mean that you are you're acting in a way that you would repeat in that situation. So every time you got to that situation, you would make a similar decision. It's important when we're trading to try to take the pulse of yourself, and by that I mean try to establish what your mood is at the moment, and you kind of have to almost consciously tell yourself, consciously take your pulse and say to yourself, am I mad now? Did something happen in another part of my life that's making me agitated? Am I thinking rationally right now? And if you're not thinking rationally at the moment, you might want to give it a few moments to back off. Controlling your emotions is one of the most important things for trading. And it took me a long time as a pit trader to be able to get my emotions out of it. And I have certain tells when I'm stressed. I do this when I'm stressed, and people on the floor could see me doing this when I'm stressed. Having a position go against you can make you do irrational things. For example, let's say you have $5,000 to play with, and you say to yourself, okay, I'm short 100 shares of this stock. If it goes against me, up $10, I'm going to do X. If it goes down $10, I'm going to do Y. All of a sudden, it starts to go against you, and you change your plan right away, and you panic, and you do something. You need to start to know yourself. If you know yourself and know that you're not going to be able to handle waiting for this to go up $10 before you cover it, then you need to have a plan that you can stick to. So a lot of it comes down to, once again, knowing yourself and having a sort of a detachment from things. If you think too much about sort of the consequences of every action, it's not going to be good for you. So it can be very hard to sit there and have stuff go against you and do nothing. It can be very tempting to want to be proactive and make something happen for yourself, but in most cases, it seems like the best thing to do. Once you have a position on that you've thought out and that you like, that you've thought about for a while, it can be, most of the time, the best thing is to do nothing. I do like the idea, if something's going really against you, to do something small to better your position. Today I was stressed because the position was going against me, and in my mind I was thinking, wow, UVXY will be at or below 30 in the next couple of days, and that really hasn't happened what I thought was going to happen. So to relieve a little bit of my stress and to make myself feel better, what I do sometimes is I cut deals with myself. I say, okay, Dave, it's not the right thing to panic and cover the position. However, instead of doing that, can you live with taking a 2-lot and rolling that out a month or a few weeks? Because taking a 2-lot and rolling it out a few weeks is bettering your position, but you're not covering and chopping yourself up. So I always, with options trading, you're always trying to kind of get around losing money in some way. Just kind of avoid losing money in some way, and that's a lot more doable with options than it is with just trading straight out stocks. But it can be very frustrating having a position and having it go against you. And once again, what I said, there's no correct answer of what the right thing to do. There are certain situations in trading where there is a right and a wrong thing to do, but as much as people on StockTwits would say, oh, you should obviously do X or Y and Z, it's not obvious most of the time what the right course of action is. So that can be hard. Thank you for your words of optimism, David Modell. All right, so let's take a look, man accounts, at your question here for a second, and I will stop with the Zen thing for a second. How about short NVIDIA August at the money puts expiring this Friday? Well, let's take a look at NVIDIA for a second. So here's my thought process here. I'm looking at NVIDIA. I'm backing it out to refresh my memory of what's been going on here. So it looks to me that selling NVIDIA at the money puts is a 50-50 shot. I mean, it can go up or it can go down. I don't have any special insight into which way it could go. I would prefer the idea of maybe selling a higher probability trade than a 50-50 trade. Maybe, for example, selling the 140, 135 put spread. You could sell that put spread for, 91 cents. However, that is, you collect $90, but you could end up losing $410 if it goes against you. However, it's better than a 50-50 bet, right? If you wanted to look at it a different way and you're comfortable selling naked options, you could sell the 140 put. If we pull up our different screen here that has deltas, the 140 put, it's giving us a 20 delta. So if you were to sell the 140 put, it's showing us here, if it's a 20 delta, then that's a 80% chance of being correct. Well, earnings just before makes it even scarier in a way. If you're selling the put, that's obviously a bullish trade, so you're saying that this little down move here is likely to turn around. The last earnings we saw, it was a down move that turned around and went straight up. However, and the other thing with a play that's the week of, that's a weekly option right ahead of earnings, is that this thing could go, it could be a winner and a loser within a couple minutes. So if you are going to do this trade and sell those puts, I would for sure definitely have a bid in ahead of time to buy them back. That way, if you get the open and it's whipping around, you could get filled. It could ultimately end the day down, but you could get filled on your puts just by nature of the fact that the thing's whipping around. But I don't see that as an obvious sort of winner trade. It just seems to be a 50-50 shot. In a sense, you are selling the puts for a certain amount of premium, so you do, your break even is down $5 if you sell them for $5, which gives you a little bit of running room, of course, but it's going to cost you some capital to sell those puts as well. Let's see. Could VIX generally edge up from here simply because of the fall coming up? AUK is one of those months historically. Sure. VIX could definitely edge up from here. The thing is that if we look at the VIX, it doesn't usually edge anywhere. It usually kind of moves around back and forth. There is this thing of seasonal volatility, and it definitely exists that people get nervous around the time that when the crash was in 87 is what it comes down to. Also, school's back for the year, people are back at work, et cetera, et cetera. There's more action going on, tends to be more volatility. But, there's a case for that and there's a case against it. Volatility is already kind of pumped. So, yeah, certainly anything could happen. There's no doubt about it. The second question, which follows from that, is if you want to make a bet that volatility is going to move higher from here, how do you make that bet in a good way? Because you could buy UVXY, but remember, there's going to be this drag stuff on UVXY. If the VIX were to if you were to freeze the VIX here and the VIX didn't move for the next year, it stayed 1975, the futures would eventually arrange themselves in contango with the futures all above spot. So if the VIX were to stay here, now if you told everyone the VIX is going to stay here and everybody knew that ahead of time, the different stuff would happen. But if just coincidentally the VIX just stayed around here for an extended period of time, the futures would eventually arrange themselves in contango above spot. And that would mean that UVXY would begin falling because it's just the nature of things that they have to charge some sort of premium to for the insurance of being able to buy UVXY. So there's pressure on these futures to arrange themselves into contango as soon as possible after a spike or after an up move. So if you get a flat move or a down move in the VIX, things are going to rearrange themselves into contango at some point. So buying UVXY thinking that, the VIX is going to go up seasonally. Well, you could be completely right about that. The VIX could go slowly up, but UVXY in the meantime could go nowhere. And it's the same with the VIX futures. It's the same with anything to do with the VIX. It's not a great efficient way to buy volatility. A better way might be to buy some SPX puts outright, or to have some sort of surrogate to the VIX. Find one of the stock, whatever your stock that you like that is of a lower volatility, and buy some premium in that possibly. What macro stuff are you watching to get a whiff of recession? Well, that's a good question. I guess we would be looking at the biggest thing would be earnings growth slowing in stocks. Obviously the market tanking. I mean, these are obvious things here, but I think companies coming out and saying that their earnings are going to be lower would be a big thing. And those would be sort of the biggest things for me. I suppose unemployment going higher, inflation going higher. AMD, let's take a look at AMD real quick here. I've never really gotten too into trading the chip stocks, although, being somebody who builds my own computer PCs, I am into, I'm an Intel guy as far as building my own computers. However, AMD has had great strides in the last couple of years, certainly. All right, so let's take a look quickly at Carvana, because I put that video out yesterday, and it's so tempting to short the stock to me. I mean, it's like I'm looking at what put spreads can I buy? I was looking earlier, I'm like, what put spreads can I buy? This thing has to go lower. And I know that's probably the reason it's going higher, because everybody thinks it's going lower. It's craziness. I was looking out here to the November. I was looking at the 80-75 put spread in November. So buy the 80 put, sell the 75 put. So you could basically buy this $5 put spread for half its price. So double your money if Carvana is 75 or below in 95 days, in 3 months. It seems so obvious, but you turn around, you make this trade, and Carvana is 120 in 3 months, and nobody's blinking at all. Well, it's funny with NVIDIA, just to go back to this for a second, that the whole dynamic behind it for a while seemed to be that that the crypto farms and all that were using the graphics cards. The fact that crypto was kind of weighed down and failing seemed to be like the whole dynamic between the about the sell-off in the stock, just to get the fundamentals for a second. And it's going to have to transition out of that being the the driver on this one. Bitcoin goes higher and people are buying NVIDIA again. Now, these correlations don't have to make sense. But if investors think that that's what's going on, then that's what happens. And NVIDIA has been, associated with this blockchain stuff for a while now. Part of Carvana is that it's expanding rapidly, and that's why people, in my understanding, which is very limited, that's why people are willing to ignore them losing money, because the product, a lot of people like it. It's expanding a lot, et cetera, et cetera. It's a growth story. Not completely dissimilar from Beyond. However, if you look at its competitors, a lot of these companies are doing nothing. We were looking at Penske Automotive, 10 times the sales, and I'm not sure it's exactly the same thing, but it just turns out that Carvana is a sexy stock and the other ones aren't. No, I understand that NVIDIA is also in cars and servers and PC graphics. And to my, from when I think of NVIDIA, I think of PC graphics. That's the number one thing I think of. I think the whole cryptocurrency thing is a new thing that kind of added to what they were doing. But in my mind, NVIDIA is a it's they make graphics cards for all your computers. Dan Quayle, yes, I do remember Dan Quayle. He had some little snafus as vice president for Bush. I wonder if Dan Quayle has a lot of money. That's kind of funny. All right, so frustrating day for shorts UVXY for sure. Let's see. If you look at a VIX chart, it almost always spikes. It almost always spikes almost every 2 months. But it makes sense to buy VIX call spreads when the VIX is low and sell at the spike. It would make sense, other than and if you're gonna buy something with UVXY or the VIX in general, buying out of the money call spreads is the cheapest thing on the board. Why is that? It's because of the skew. The skew makes the higher out of the money a call is, the higher price it is with UVXY, because people buy, one way to cheaply hedge your long, your long whatever ETF, the SPY or whatever. One way to cheaply hedge against a crash is to buy out of the money UVXY calls, and thus they're in demand. And what that does is it flattens out. Here, you can look at my pretty face again here for a second. The fact that out of the money calls are in demand in UVXY means that it flattens out. The skew means it flattens out the prices of out of the money call spreads. So those spreads are a bargain compared with anything else on the board with UVXY. The question is, and I have friends who are, for the most point, they play this to the short side. But when volatility, when it gets back down to 11, when it gets down to 11, where we were a couple months ago, they're going to buy. They're going to buy out of the money calls or call spreads. It's kind of the same thing in UVXY. So, yeah, it makes sense. You just want to keep track of the fact that it is costing you in decay, and the clock is ticking for you. So it has to be timed strategically to work, but it definitely is a good idea. And like I said, when you get to a point where we're taking out the all-time lows again, which happens quite often in UVXY, but we're not there at the moment, of course. But when we get to the point where the VIX is back down to like 11, 10, maybe even 12, and we've had a big down move, you could look to buy some out of the money calls or out of the money call spreads and hang out. And you can do stuff like buy out of the money call spread and sell some front month farther out of the money stuff against them, turn it into sort of a poor man's covered call type situation, that sort of thing. I personally play UVXY only to the downside. I wait till there's a pop and then I short it because I feel like I have more things going for me there. Another thought to get long where you're collecting decay, if nothing happens, is to sell out of the money puts strategically. So, for example, UVXY gets back down to 24. You might go out to October and sell some of the 20 puts, something like that. That way you and you might do a little bit of both. You might buy, UVXY gets back to 22, 23. You might buy the November 30, 35 call spread, and to help finance it, you might sell some out of the money puts farther down. So you might sell the 20 puts. This is saying if this was back down to 25, you might sell some out of the money puts to help finance buying this call spread. So you have sort of this risk reversal type thing going, and that's a good idea. $0.50 trader. Yeah, he was definitely buying protection, but we feel that I think it's generally thought that the 50-cent trader was hedging a huge portfolio, and thus, what does he really want to happen? He wants whatever he's buying in the VIX, he wants that to be a loser for him because he's long the market in some way, and he's using the VIX to hedge himself. So if his trades come in big in the VIX, that means he's actually losing money because most of his money is long the market. That's what we're looking against. It's when just looking at somebody's options trade, like one options trade or two by themselves and trying to get some read of either their opinion of the market or how they're actually generally positioned can be very hard because a lot of the stuff people do is hedging. And sometimes people have if they're running a fund or something, the wording of the fund says they can only have X amount of exposure and they need to cover a certain amount of exposure, and they might do so by buying out of the money VIX calls or puts. Makes sense. Very clever. Mr. Carlson, just to get back to your point once again, it does look like you get a 50% spike once a year. You get a 10 or 20% spike every couple months. That's true in general, but figuring out when that spike's going to be is the hard part, because if you look back historically, we don't have that much data historically to look at, unfortunately. But if we look through, this is just 3 years here, but what if you'd picked, let me get out of the way here, sorry I'm in the way again. This is just 3 years here, but what if you'd said April, May, back here of 2018, you said, well, I'm going to buy some call spreads because it looks like we're going to get a pop. Well, you get a little pop here, but then, whoa, the rest, all the way, months and months and months and months is just going against you. And how many months are you willing to buy those call spreads and have it just suck wind before you kind of give up? Unless you're committed, stay committed to the fact that this is going to spike and you're going to stick with it till it spikes. You still could find yourself in a situation where the spike just brings back most of your money. So you've had all this, you've had your capital, it's been stuck in this position for months and months and months, and you've just gotten back to even with the spike. So that's the tough thing, and that's why I just personally feel like you've got more going for you if you are shorting into spikes. You've got more going for you because, just looking at the chart of UVXY, it's not slowly going up, it's slowly going down, right? We can all agree on that. We have these pops, but it's slowly going lower. And so there must be something that favors it going lower as opposed to favoring it going higher. And we know what those things are, but just looking at the chart is proof that it's slowly going lower. Seems like the TRS data for past VIX options quote is almost up. Do you know of a way? I'm not the greatest expert in TOS. There's people, I know basic functionality of it. If you want to give me a specific example as to how the past options quotes are messed up, maybe I can ask somebody about it. If you want to leave me a message in the comments, or here, I'll post my email address, and if you just write me sort of specifically what you see as is going wrong, I can look into it for you and get an answer to you. That's my email address to check on that. All right, and as we talk, the market, it's like volatility is cranked, and it doesn't seem to be coming in here, even though we kind of seem like we are... when we go off the lows a little bit, it's still the VIX is cranked here. Let's take a look at... All right, so here we are now. We're almost back at the lows. If we do take a look at the VIX for the day, we've got that here. And, it's painful to have a position going against you and you're just sitting there and you feel powerless to do anything about it. But that is the name of the game sometimes, is you just have to wait this stuff out, and whoever's the most patient wins, And it's never clear exactly what to do. It could be right now you say, oh, we got to give up on the position, cover the position right here. And maybe tomorrow something crazy happens and volatility goes to 60, right? And you'd be like, oh, what a great trade that was to cover the whole position. On the other hand, maybe this is the top of the VIX for the next year, and it comes back a little tomorrow, comes back a little the next day, and pretty soon we're back at 28 in UVXY. It's very hard to figure out what to do in real time, and to make a way to be mechanical about it. If you're really having doubts about your position and you really, really don't like it, my suggestion to you, and I make this suggestion all the time when people come on and ask me what to do when something's going against them for a while, and my suggestion to them is to cover half of it. And you're never going to be happy when you do that, because if it continues to go against you, you'll be happy it continues to go against you that you did something there, but you're not going to be overall happy because you're losing money. But if you cover half and then it ends up going your way after, you're going to be mad that you covered some of it. But covering half when you're nervous about something, it cuts your problem in half and can be a good solution if you're really struggling over a position. I'm not really struggling over our position right now. I feel comfortable with the time range. We've got 26 days here. And, worst comes to worst, we can roll it out. So I'm feeling comfortable right now about our position here. I'm just saying, if you have a position on that you don't like and it's really bugging you, cover half especially if it's like a long-term position. Do something little up to covering half, and your position, your problem's cut in half, and you'll feel better about it. All right, I've droned on long enough here. And Apple. Well, this is the whole thing that Kramer was talking about last time we had a big sell-off, that Apple really wasn't that phased. And you know what? Carvana's not that phased. BYND's up $4. I did, by the way, folks, just to update you, buy a little bit of MNK today. Not in this account, but in another account. And this is just for a short-term bounce. If I get a little pop, then I will. I'll sell it out pretty quickly. But did buy some MNK. You sold some Apple puts. Well, then we're both rooting for the market to go up. So good. Yeah, I found this guy on StockTwits who, I guess he's he's big as in he has 100,000 people following him in StockTwits. Let's see if I can find him here again. And he was saying that this move lately is basically like summer chop, he was calling it. Essentially just saying like there's not too much to worry about with, and I think it was in Carvana where he was posting, but basically just saying that the overall, here's this guy, GT Lackey. I just found him. Interesting stuff to follow, but was basically saying like, you know, the market to him is not really in like complete failure mode right now. You know, but you can find somebody who's going to have your view no matter where you look. It's kind of like with politics. You can find somebody who's going to agree with you on the internet for whatever crazy position you have or idea you have. So that doesn't necessarily mean anything that you find someone that agrees with you. Well, good luck on your puts, Manicouns. I've sold Apple puts before and it's worked out. You know, I always look to Tesla because, I don't know. I know I have friends that have been really successful in selling puts in this one, but I always looked to Tesla to sell some out of the money puts for a little income from time to time. I look at Amazon sometimes, although Amazon I haven't been as successful as with some other ones. Let's look at Amazon here for a second. Year to date, really kind of where it was. Hold on. Doesn't it give you a different viewpoint depending on what time frame you use for charts? That's the other thing. You can make a case for whatever position you want by changing the time frame of a chart. If you move this chart like that, you might be like, oh wow, look, it's going up. That's really bullish. And then you move it down to there and it's like, no, it's going down. People change their, so I wouldn't put a lot of stock into charts. I know a lot of what I'm telling you is not maybe reassuring you about trading, but I just want people to understand that there is no exact science here, and it is difficult. And people saying that they've got it figured out, and you just take this class from them and you're going to have it figured out, is not necessarily true. And it looks like we might take out the lows of the day so far. Let's take a look here on the daily for the E-minis. And the low is 11 o'clock. We haven't quite taken that out yet, but definitely seems to be drifting lower today on this one. VIX almost up to 20 again. UVXY up almost $2. So not a great day for the position here. We'll see what happens moving forward. Thanks for watching today with me, and if I didn't give you total optimism about everything with the markets, at least I gave you some reality, and let you know that we're all in the same boat to some extent, and that a lot of decisions can be ambiguous a lot of the time. That's just the way it is in life. That's the way it is with trading as well. All right, thanks for watching, folks. We'll see you in the next one.